All right, so we started the new U.S. presidency with records. This was the first time that we've ever had a all-time high on Inauguration Day in hundreds of years for the Dow Jones Industrial Average, and it's also the biggest move that we've had in the S&P 500 from Election Day to Inauguration Day that we've ever had as well. The previous record was during the Roaring '20s, so probably not the best comparison that we want to have, but nonetheless a new record in that standpoint too. So we started off very strong. Unfortunately, that raises the bar. It's kind of like having such a strong 2020. It's going to be hard to have a repeat for 2021, even though we've started really good on the month because we have a really high bar to a high basis to start from. So let's talk about what drove the markets here today. It was some old familiar names that kind of led us up today, and we'll talk about how this jives with what we've said in previous market outlook videos with maybe another near term run or two left. So we'll break that down, and we'll take a look at a stock that had this great little breakout pattern as well too, and talk about how to trade that here. So let's go ahead and get started. Today is Wednesday, January the 20th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. And you can see what a great day we had today. And I mentioned in my class today that if it wasn't for the gap, we'd have a overbought cluster on the S&P. A little late pullback kept us from having the overbought cluster on the futures contract. You can see the near-term line there finished in the 79th, this number over here, the blue number. So if you look at it now, the 79th percentile, everything else above the 84th percentile. So that's how close we came to an overbought cluster yesterday on the S&P 500. So go back to SPX here, and you can see so pretty decent bullish day today. We continue to kind of pull away here from that the 30-day moving average. That's been an issue, not only like from the 30-day moving average, but you can see we're still very high. This is from the 200-day moving average. We're at one of the highest levels we've been at. We're at 16% right now, and 37% above on the Russell 2000, which continues to be near record highs for the Russell 2000. So the Nasdaq made the biggest push. It got back up to over 20% above after this surge in August that culminated in a 30% run above the 30-day moving average. So you can see it was a Nasdaq-driven move early, and then now look at the Russell. You can see the big difference here between the Nasdaq and the Russell. The Russell had been well below its 200-day moving average here, more so than the Nasdaq was early in the year, and then the Russell made a run here in June to get above its 200-day moving average, and then the Nasdaq made the biggest run in September, and then now the run is clearly coming from the Russell 2000, while everything else has been kind of staying 15% above the 200-day moving average, 20% above this whole time. So kind of maintaining the same pace as the growth of the 200. The Russell's really taken off during this time, and it appears to be kind of peaking and rolling over there. So we'll kind of keep our eyes on that one. But you can see that even the Russell 2000, not as bullish yesterday. We didn't get up to a new high. The near-term line starting to diverge a little bit. It didn't pull back. It didn't finish this run like it did on the S&P. It started a little bit later too, but we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days now. The S&P did fall down below the near-term line did, and we're on that new run. So we talked about on last week on Friday's video that we're probably get a new near-term run or two out of here before this intermediate rally is over with, and it looks like we're on a new near-term run right now to a new high. So let's take a look at some of these other charts. If you look at the long-term chart, this week's candle so far, now we got one more day or 2 more days left, but we have a higher high, we have a higher close, we don't have a lower shadow, so it's a very bullish candle. And this is 1, 2, 3, 4, see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks now on this current intermediate rally that you can see here with a very high PPO, the Russell 2000. Again, this is the one that's been really taken off here since September. You can see again still very bullish candle too. So we're not there. That's why I said that we had a good chance for another near-term rally or two, because we're not to the transition point yet in any of these indexes here. Looking at the 3 green arrow chart, you can see we are back to 3 green arrows. The MACD has turned back up. Let me show you what that looks like on the 2-line version of the chart. We're kind of going up and down around the moving average right now. We're easily back above the 8-day. I told you before too that a intermediate pullback doesn't start until you break the 23-day moving average. It also doesn't start until you at least break the 17 and hold that breakdown. We got down to the 17-day at the end of last week, and then bouncing back up yesterday above the 8-day, and then clearly getting back above that there. So very bullish pattern. You can see we obviously are in the path of least resistance here, well above the value area. There's no volume ahead of us. If you look at the RSI and the CCI, we haven't broken below the lower half of the chart on the CCI. We haven't broken below 50. We're back above 60 here. We're back above 100. So we're obviously clearly still in bullish mode. We're back above 30 on the positive directional index, still below 20 on the negative. The ADX is still pretty strong. We have dark green shading there because the ADX is still above 25. And then the trend strength indicator is still very strong. We're above 5 or above 80. And it's hard to break very strong trends when they get to this point. It takes a lot to get this noise balance down to 0 to where we're like, okay, until then, we kind of continue to ride that trend while it's going. If you take a look at the intraday chart, we did get a little bit of a gap higher, and so look for that to be filled in at some point in time. That's not any kind of special gap. It's still a common gap. Now we are above that point of control where we had broken down below that. Now we're above that point of control, and this low point after today is going to move up to there. So the 4-week range will start tightening up just a little bit there, but we did get a new high. So we got a new high tag over in this direction, and you can see, we can fill in that gap and still not really break, a significant support here on a short-term basis. You look at today's volatility, and you can see, this is the lowest level that we've had in volatility for quite a while. On this whole intermediate run, this is the lowest close we've had in volatility on a relative basis. We're still above 20. We haven't broken down below 20, but we're still on a relative basis there below the 85th percentile. That's the first time we've closed below the 85th percentile. And I mentioned in class we need to keep an eye on the range for volatility, which is 2.5 points now. The average range for the VIX, if I look at the ATR here, and then I go to the average range, and we look at the VIX, the average range for the VIX is 6.5 points. So for us to be getting a range here on the VIX of, for us to be getting a range right now of less than 2.5 points means that volatility is really tightening up. I think if we get another week, as we finish this week with this range, we get another week maybe going into the end of the month, and volatility comes down towards 80%, that's going to be a precursor to a bigger jump in volatility. Is this really small ranges? I don't think we break 20 before we get an intermediate exhale. So if we kind of stay around here with the really small ranges up and down, but we stay around these low 20s, and then we get to the 80th or really close to 80% there on a relative basis, that's going to be the signs that, okay, there could be a bounce in volatility coming really soon. Again, they occur just like in a week. It just takes a week to get ones. This is when the intermediate run started before. But remember, the intermediate runs typically start with a run to 105% on like this one and like this one over here. They typically they start with a run to 105%, and then they just stay high for however long the volatility stays high here, for however long that takes. So just kind of keep an eye. I'll keep an eye on, this last intermediate run. It started. We were so low. When it started, we didn't even get through the neutral zone. We stayed below 90%. We finished with a move. The intermediate run finished with a move up to 105%. That's atypical. This is more typical, these two over here. You can see some of these over here as well on a daily basis. Remember, on the daily chart is what you can look at, and you can see how these runs started with a move up to, these intermediate pullbacks started with a move up to 105%, and then we just stay higher, right? So, and like I said, this one we finished at that. So that, this is more typical, and I expect that, again, the next intermediate run will start with a jump in volatility up towards those levels. Let's take a look at how things performed yesterday. The Qs really bounced back. Everything, all these risk asset classes really jumping up pretty sharply here yesterday. Let's go to 5-minute chart, but it was dominated by the Qs. The Qs in real estate and emerging markets. Gold was rallying really strongly, even though the dollar was pretty flat. The dollar is moving to the downside. So when you look at a chart of the dollar here, we looked at this before as well in our last video. The dollar compared to the euro has really broken down below the 30-day moving average, got below the 23% retracement, hit the 38% line, and we are now bouncing back up to the 23% retracement level, breaking back through that. Then we start a new run, a new bullish run on the euro, a new bearish run on the dollar. I think we are just going to hit some resistance here before we roll back over and potentially work our way all the way through this retracement zone as we get more of an exhale. So I think while the S&P goes through another near-term run or two, we kind of stay in this area. If we break out, we break out, and we just keep going. But I don't if we do, we might get light green shading in the yellow line, and then a selling opportunity. And I'm not looking for a big bullish run on the dollar. Like, I'm just looking for this intermediate pullback, and that's it. I don't think we've started one here. The dollar has started, the euro has started an intermediate pullback, which means the dollar is starting an intermediate jump, bounce. But I don't think it's ending with this little rally. I think we're getting up to this level and rolling over, and that has implications on yields. The yields are bouncing back up just a little bit here, but they are well above the 30-day moving average. They're starting to show signs of weakness. The near-term line came down. The intermediate line came below its market sentiment line. And you can see on a weekly basis, we're well above that moving average. So I don't think necessarily we're going to fall off a cliff again, but I think we're going to slow down and come down a little bit as we come down to that moving average there. I also wanted to take a look at commodity prices, which are also very strongly bullish right now, and the same thing is happening there. So that's the implications of a rising dollar will put some pressure on crude oil, and you can see gold has also had its pullback, and it had a nice little bounce here. I don't expect that bounce to change what currently looks like we are in the midst of a intermediate decline on gold. So again, temporary though, and maybe down to the 62%, 1700, and that's it because of a strengthening dollar. I do expect the gold to find some support, whether it's at the 50 or the 62% retracement, and bounce off of that eventually. Now again, because of the long-term weakness in the dollar, but I don't expect gold to outperform equities. So if we're buying gold, I've told you before, if we're buying gold simply because we think the dollar is going to drop in the long term, keep in mind that there's a lot of other things that do well when the dollar drops in the long term too, that will give you much better returns than gold. Gold is more of a safe haven asset class. It can definitely be a diversification to your portfolio, but not something you want to buy just because the dollar is dropping. When you have other alternatives that benefit from the dollar dropping too, they can give you better, like in a risk appetite environment, much better return opportunities than putting your money in this safe haven asset class. Let's take a look at how the sectors performed here yesterday. So we'll go to the sector comparison chart and just go to how we did here yesterday. And you can see, here, let's go to a 10-minute chart. You can see that it was communication services, technology, real estate's up there, and then consumer discretionary. There's your leadership, and that's why the S&P was so strong, because your leadership was so strong. All these areas that had been winning, they lagged, and in fact, financials had a loss. So again, this is, the fact that we're kind of shifting back suggests that more of an intermediate pullback is coming, because they will outperform during the pullback, because they've been underperforming for so long, and these have such good gains, as you saw. If I were to go all the way back to again that September 24th time frame, we'll go to a daily chart. They have such good gains to give up during an intermediate pullback, and these areas have been lagging. These large cap areas have been lagging, so expect them not to go up a lot, but at least to outperform these smaller areas for a while. And that will be a sign, and then eventually continue to outperform and lead the market back up higher off of the next intermediate low point. One stock that really had a nice little breakout here yesterday was Lennar. Lennar Holdings, Lennar Corp, which is a home building company. You can see a nice dark green shading and a green line, a nice little breakout pattern here. If you look at its 3 green arrow chart, you can see it had 3 green arrows and a jump at least above average volume. So an opportunity, we might be making a run up to the upside. You can see its RSI jumped up above 60. Eventually here, RSI jumped above 60. The CCI broke above 200. The DMI showed a breakout pattern as well, getting up above 30, well above 30, with the positive or negative index getting below 20, breaking through the top of the value area on the Bollinger Bands. You can see how it broke through that top and up above the upper Bollinger Band and up above the Keltner channel as well. So very good bullish breakout pattern. So what we did on Lennar is, and again we did this in our Market Outlook Live, is we did a little bit of a directional trade. We bought a long-term call, $90 call, or not a long-term call. We bought a February call at the $90 strike and sold the 92.5 call to help lower the cost a little bit. It gave us a small risk of about $500 with a more than 5-to-1 reward to risk ratio if it works out. So again, a little bit more of a directional trade because we have a really good bullish breakout pattern here, looking like we might make a run up to a new high and form a divergent high here with that PPO. So that wraps us up for today. As always, thank you all very much for coming on class today. I appreciate or watching the Market Outlook Live. And remember to like that video down below and comment on anything that stood out to you. And we'll see you all next time.